Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The NASDAQ continues to run away from the rest of the pack while there's new life in the alternative energy market. Discovery Watch's John Kaiser digs into the junior miners. Are they about to have a huge surge in popularity? And is that a long-term trend or just their regular summer boost? John Rubino, author of the book The Money Bubble, comments on what could derail the current gold bull market, what's happening with silver, and who, if anyone, can bail us out of the current economic crisis. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure to be with you, Jim.
Ross, the NASDAQ continued madness through most of the week.
It is. It's just on a roll here. You got now. There's two parts to the NASDAQ. You know, you've got the big cap names out there that are running and really carrying this market. The NDX closed. If we look at it, sort of over the last probably 10 months since the market was started to come to life last August. NASDAQ's up 45%, and that's after the debacle that we had in March. So, whereas S&P's up about 12%, the Dow's up maybe 2%, the NYSE and the Russell are down from this point last year. So, what you've got is the NASDAQ leading the way, all the high-tech companies, but within it, if you take a look at the capitalization index of the NDX versus the equal weighted one, then you find that ratio is at multi-year lows. So just goes to show here that this is a very selective rally, and one, you got to play with the strength and be short on the weak ones. As far as not just the NASDAQ is concerned, but the general market. You know, you've got the financials, the XLF, which just is not participating, the Russell, the IWM, having a tough time. These tourist stocks, like the Carnival and Norwegian Cruise Lines had the good pop off the bottom, but are giving most of that back. The same thing's happening with Boeing and with the airlines. So clearly, if you're in this market, you want to make sure you're with the strong ones. However, I do have to put a little caveat out here that some of the big names in this, like Apple and Tesla, they're getting upside exhaustion levels when we take a look at the daily and weekly charts. So wouldn't be at all surprised that you get a pretty decent correction in there. And those two names in particular look as though there might be some short-term vulnerability. I don't think I'd be playing against them long-term, but definitely look at for some short-term opportunities. Another area that's had real life in it has been over in the fuel cell area, stock and alternative energies, stocks like Ballard Power. We've got good upside exhaustion signals in that one. I've got about 6 or 7 of these in this stock since 2000. It loves to make good runs, gets in favor for a while, and then gets way ahead of itself. And the typical correction tends to be a decline, sort of a minimum of 20% to more normal of 40 or 50%. So if people are looking for something with a bit of volatility, that's an item they might look at. Also, the solar stocks. You take a look at solar itself, or you take a look at the ETF TAN. Getting a little ahead of themselves, could be ready for a decent pullback, and might be an opportunity, but only on a pullback.
Is there anything to mention about crude, or is it kind of the calm before the storm?
It's the calm in the middle of the storm right now. You know, it's we're sitting here in this 41-ish range. For me, we've been almost a month now trading sort of between 36 and 40.5 to 41. It still looks as though best support will be somewhere down under 35, but it's just not attracting a lot of attention for me. And if I take a look at the stocks in there, the XLE, that's now given back about half of the rally off the bottom that we had in March. It had a pretty good run into the early part of June, but it's giving that back. And if we're going to have strength in the oil market, you'd anticipate that you might see a bit more happening over in the stocks.
Is there life in the grains right now?
Yes. Corn and soybeans starting to show decent moves off their bottoms. And the DBA, which is the Deutsche Bank Agricultural ETF that we track, we sort of called a bottom on this one in the last month or so. And it's had its first little move up. It's up to its 50-day moving average, having a little bit of resistance there. But it's a decent-looking base. And, this is an area that's been under pressure for a long time. And I think clearly that's one that's got pretty decent opportunity. The index is around 13.5. I think you could be looking at something up in the $16 to $18 range, which percentage-wise isn't a bad play coming off a bottom. And I did get a monthly capitulation, and my capitulation signals are they're far better at picking bottoms than, say, even the exhaustion is at the top end of a move. The bottom of the stock market's there. That's third and fourth week of March. Some great capitulations in most of the stocks. If I take a look over now, that DBA agricultural ETF put in a capitulation low in June. So the probabilities of it basing or trying to turn off this type of a low has got pretty high probabilities in it.
And Ross, of course, gold still monster. What's going on?
Yeah, I guess finally, enough money has been spent by various central banks that the gold market managed to finally get through the $1,800 level. Futures contracts are a shade above there. The cash level is still below. Typically you do have trading ranges when you get around the even hundred numbers, like 1,700, 1,800, etc. You do a bit of thrashing around. And we had looked after that low in March, April, that we would have pretty good resistance for the next 3 months and be unable to do, much in the way of sustained moves on the upside. At this point, clearly it's trying to break through the resistance. At 1815 to 1817 range is the one we're looking at. Closing through there, it should gain some momentum. We look at percentage breakouts above old highs. I'm not so interested in whether something makes a marginal high, for a day or so above an old high. I want to see it above by a certain amount. In the case of gold, that percentage number works out to an 1817 calculation. If it gets through that, then our next target is 1888. That's been a long-standing one here for the last year or so. And the other thing of note is that historically, when gold makes a new closing high during July, of which it's only done 7 times since 1970, it then will put in an interim high, and we can measure in the next few weeks we measure that from the last corrective low. So with it having made a new high for the year here, our calculations are for this cycle run that you'll be looking at July the 24th as an optimum high for gold, plus or minus, it could be plus or minus 3 or 4 days either side, but that 24th is an optimum time window, and we'll see what it's done by then. I wouldn't be surprised that number in the high 1800s does come into play by the time we finish the month of July.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, John Kaiser next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Kaiser, who's from our weekly show Discovery Watch, his website kaiserresearch.com. Welcome back to This Week in Money.
Jim, it's a pleasure to be back on This Week in Money.
John, do you have a special offer for our listeners?
I do have a special offer. We're in the middle, finally, of an awakening of what has been a decade-long bear market for the resource juniors. Over the next 6 months is probably going to be the most exciting time, especially for bottom fishers, because this is like a pan of corn kernels. For the last decade, most of the kernels just sat in the bottom of the pan and burned. Maybe one popped now and then. But now we have a proper pan of corn kernels starting to pop. And a few have already started to pop. More will be popping over the next while. So this is almost like shooting fish in the barrel, because not all these companies are fully awake to what is happening. And so my normal annual membership costs $450 US, but I'm now doing a special of $275 off. It's only good to the end of the year, so it's not really a bargain, but it is a cheaper upfront cost. It's intended for newcomers. I think we are witnessing an explosion of completely novice interest in a sector that has been, more people, boomers and old timers. So this special, $275, you'll be able to take it sooner than later, and it's good till the end of the year.
John, can you maybe give us a little picture of what Kaiser Research is all about?
Kaiser Research is two things. One, it's an information research portal. So the subscribers I have now tend to be do-it-yourself researchers. They know how to use the search engine. They're not going to wait for me to point out stocks that are ready to pop out of the bottom. So they use their parameters to go in there and find them. It's a giant time-saving tool. But of course, what most people want is for me to curate this, to come up with the best bets, the cheapest bets, and then as they start evolving, cover them, explain how much is left to go, what are we waiting for. I have 30 favorites right now in 2020. As a group, they're up 62% from the start of the year. But we have 100 other ones that don't quite make favorite status, but on which we put bottom fish classification, which are things that people can pick and choose from. So people who think they're coming late to the party, it's not really the case, because only a portion of these companies have started to move. In fact, of the 54% of companies at the start of June that were trading below 10 cents, that's dropped to 40% of the total. 200 companies moved from prices like 5 cents into the 10 to 20 cents. But there's still another 600 companies at cheap prices, and many of them are diamonds in the rough with competent technical teams who are just waking up. So research platform and me as almost like a trout fishing guide pointing out, there's one, there's another one, go for it.
John, does it look like mining juniors are in a summer rally or a long-term bull market?
That is probably the most important question. At the end of 2015, things were really, really dismal. Traded value was extremely low, and yet by the end of January 2016, we had a tremendous run in the resource juniors. In fact, the percentage of stocks trading below 10 cents, they were up at 64%. It actually dropped over an 8-month period down to only 33% of all the companies. But that rally, which tricked us, was driven by the price of gold rising. It looked like it had finally turned around, but it only got to around $1,400 before it stalled. And then the general rally stalled. It was relying on gold to drag the market higher. In 2017, we had a bit of a blip when Novo had its WITS 2.0 Pilbara story, where it looked like maybe the 2.5 billion ounces found in South Africa 100 years ago. Something similar was showing up in the Pilbara, but the measurement problem killed that in 2018. The last couple of years have been quite dismal. But what I see different about this rally, beyond gold now being at $1,800, is that it isn't so much gold driving the interest in the market, but this strange shift where the market, the investors want the company to take charge of its own destiny. This old business of waiting for gold to go up and drag a worthless asset into the money as the value creation strategy, investors became very tired of it. And the reason I say this, I've watched this explosion of financings during the past 4 weeks as Bay Street suddenly scrambled and got into the game. We see a bought deal announced in the morning. By the afternoon, it's been upsized 50%. And 2 weeks later, when it's closed, it's double the original amount. This money is going into existing gold systems. These are not your, 2 million ounces at a half-gram optionality play where when gold lasts to $2,000 and keeps going, we'll be into the money. That was the story of 2003 to 2011. This is different. These are projects where, there may be 200, 400, maybe 600,000 ounces, but they're distributed in a way that it just doesn't have the scale to be mineable even at a better gold price. And yet money is going into these plays because the geologists using their leapfrog compilations, 3D spinning around, are coming up with new theories that there is a lot more to these systems than was assumed in the past. And all it takes is exploration dollars, drilling money, to show that it extends considerably deeper than thought before and that it repeats itself along strike. This is discovery exploration. And this is the companies taking the destiny, the value creation destiny, into their own hands. The investors are putting up the capital and they're saying, we know we will have to give you more down the road, so just show us progress that your theory is correct, that you're making this system bigger and better. And the third part of this triad that's completely new, which is, I think, going to drive this market to unprecedented bull levels, is what I call the retail investor as an influencer. Retail investors are coming into this market, and this isn't, people over 55 years old for whom this sector is supposed to be suitable. This is the younger generation, the ones I call post-boomers, the Generation X, the millennials, and even Generation Z, or Z as you would call it in Canada. These are now discovering the resource junior sector, and they are not interested in just momentum chasing like they were with the cannabis space. They are looking at gambling on outcomes that aren't just an overnight outcome, but are outcomes, fundamental outcomes that evolve over time, which is why there's a strong interest in the nature of the exploration play. What does this gold vein system look like before? What do you think you can turn it into? What are you doing about it? And it is the role of these influencers understanding this stuff and using their network hubs to tell other people around it in a context of an emerging bull cycle for the resource juniors against this backdrop of a rising gold market. This is what's stunning about this. I think this is very different from 2016. And at the end of the day, next year, when gold has blasted through $2,000, that will give a whole new foundation to this bull cycle.
Do exploration juniors move towards the end of a bull market?
Well, this is there's two scales for this. One, if you look at the general market cycle, which is supposed to be linked to the business cycle, and when the business cycle gets long in tooth and stocks are overpriced and nobody really wants to admit that it's probably all going to go down, kind of what it looked like at the start of this year before COVID have made it go down, there tends to be a shift of capital into riskier ventures. And typically over the past 30 years, we've seen the exploration juniors attract interest from the market late during the economic general market cycle. But your question also applies within the market cycle. For example, in the gold producers, they moved earlier this year. They're up 50 to 100%, but they've kind of stalled. They're waiting to see how much higher gold is going to go. But this next segment, these sort of mid-tier exploration companies, they're not really supposed to start flourishing until the bull cycle is much more advanced. Historically, in the 80s and 90s, we did not have metal price-driven bull cycles in the junior sector. It was always driven by some huge discovery that blew everybody away, a Hemlo, an SK Creek, an Ikati, a Voisey's Bay, a fake Briex, a Parina. These were the big discoveries that would switch the glass half full for the audience, just pull in money, and there would be this Me Too phenomenon until, pretty much nothing else beyond the original discovery was discovered. So it's unusual now that we're seeing this resource junior bull cycle erupt down more at the discovery exploration end, especially since in 2003 to 2011, it was really dominated by feasibility demonstration where companies acquired these forgotten deposits that weren't good enough in the 80s and 90s, but in the context of higher real base metal prices and gold's run to $1,900, all of a sudden these were in the money. That was the game. Exploration was just mechanical drilling off, infill drilling, met studies, really sort of boring stuff. But it was the rising metal price that was the engine. The odd big discovery like Fruta del Norte, they were just little blips against this background. And yeah, it was great to see them happen, but they weren't what drove that bull cycle. So we're now going back almost to the 80s and 90s, except this time around we have a reason to believe that the metal price trend for gold is finally on a sustainable uptrend path.
Instead of a glass half empty market for the mining juniors, you're telling us the glass is switching to half full. Do you think it'll start filling up and become a bubble?
Well, after 10 years of a glass that was even worse than half empty, it was like, only quarter full and draining away. It is such a relief to see that people are willing to give a project the benefit of the doubt. And the significance of shifting to a glass half full market is, in the past, if a company could raise enough money and it would go on a drill program, there was no anticipation cycle. People would say, yeah, call us when you have 100 meters of 10-gram gold, and then we'll pay attention to you. So people would put up money at, say, 15 cents. The company would spend it, and it would probably spend most of that exploration cycle sitting between 10 and 15 cents, and then when less than stellar results came out, it would go down to 10 cents. So it was a really punishing, unrewarding decade that we have. Now at least we have people willing to have the anticipation to say, okay, I'm willing to hold this, to wait to see the results. I'm paying close attention to news releases that suggest that the core looks good, that the zone is evolving as expected. So there is now a growing interest in the geological details about an exploration play. Now, for it to go to 90% full and create a bubble type of a market, what we need to see is giant world-class discoveries to emerge from all these plays. There really isn't a world-class discovery, at least a validated one, that we can point to right now to say, wow, look what these Canadian explorers can accomplish. I think this will come now that a lot of money is being raised by the sector and going into the ground, not just to infill drill existing systems, but to step out and test new targets and find stuff that's undercover, that's deeper, that's more obscure. This is what could drive the market to 90% full type situation. But it will take at least a year for those conditions to happen, which is what's so beautiful about this situation. I mean, this turning point happened after the March COVID crash and only really started going in late May and started to accelerate in late June. And we'll probably have a bit of a summer pause here, but if gold continues to grind higher, I wouldn't count on too much of the summer doldrums giving everybody an opportunity to think long and hard about which stocks to buy.
Where's the money pouring into the junior miners coming from? Retail, high net worth, institutions?
I do not think it is coming from institutions except the die-hard specialty institutions that focus on the precious metals sector. The institutions have to explain to their shareholders, why did we invest in this after it goes bad? They loved that 2003 to 2011 cycle where it was the rising metal prices. They could put the deposit into their spreadsheets and say, wow, if copper goes from $1.50 to $2.50, look how wonderful this is, and the trend is that way. We've got the super cycle China narrative there, and in the case of gold, well, we've got this incredible expansion of capital through this mortgage securitization business. All of this is a big bubble, and then when the quantitative easing started after the 2008 financial crisis, oh wow, we got all this money printing, that's going to end up driving gold higher. And so that logic is what the institutions need. They need this cover to explain why they are exposed to a resource junior company that has gone bad. So it's the specialty ones who have already told their unit holders this is what we do, who are in this market now. The money that's coming into these bought deals from Bay Street, this is what I believe to be high net worth money or even bigger family office money where they take responsibility for it. They smell the turn in the market. They see the narrative as one of lots of dollars coming in, exploration creating value, gold slowly in the background dragging it up, and retail investors are coming back into this market. That whole post-boomer generation that, as I mentioned earlier, got their feet wet dabbling in cannabis, now they're looking at this space, and it's a different space. It's a more complex space because a junior can't go to the moon. There is an upside. The upside limit is based on the value of the finite value of the deposit, which is going to be finite by its own nature. It's not going to be like some widget of which infinite copies end up being sold. So retail and high net worth, sophisticated investors, family offices, and the specialty institutions. That's what's coming into the market now.
What will it take to bring institutions back to mining juniors? We saw institutions come into the late sort of 1995 to 97 cycle when huge discoveries such as Voisey's Bay and Ekati delivered monumental gains. The institutions need liquidity. They need to be able to get in. They need to be able to get out. The market cap of the resource juniors is still relatively
relatively low compared to, say, during the 2009 to 2011 period. Plus, they need to see that move from gold past 2,000 into 3,000, that 2,000, 3,000 range, without, obvious inflation coming into the equation. Yes, the possibility of inflation down the road, that's going to be part of the equation, but it's the real price move. And you think, okay, $1,800 to, say, $2,500, that's a 30% move. Whoop-de-doo if you're just owning gold. Maybe great if you're buying gold futures and you're very leveraged. But the real action, the real leverage is in what a modest 30-40% real price move does in gold, does for the value of ounces in the ground, for what counts as an economic grade intersection. When they see that repricing of gold into the $2,000 to $3,000 range, that's when I think the broader market, the broader institutional market will come into this space.
Are social media platforms bringing new audiences to the junior mining space?
The social media platforms such as Twitter, Facebook, where individuals have their own account, they can have a secret name, or they can be themselves, understood that this is John Kaiser, but maybe goes by Kaiser Research. This is different from, say, the past 2 decades when you had stock forums such as in the beginning Silicon Investor and then Stockhouse. In Australia, you have Hot Copper. You have all these channels like the stock price, and so you sign up for that as an anonymous person. And it's all kind of like bashing and pumping, and it's linear, and it doesn't really do anything. But if you have a Twitter account, you acquire followers. And you become an influencer. Now, the young people are very much into that, and they're all trying to figure out how to be outrageous and attract followers and eyeballs so that the Twitter guys and the Facebook guys put ads in there and they get their little pennies in. But in the stock market arena, these influencers, they would go in there and buy the stock in the market, and they don't care if they get any money from the advertisers in there. They're hoping to be able to influence their audience to help the stock go higher, and then they can sell at a profit and move on to something else. And there's no really big influencers like that. There's one right now, I think his name's David Portnoy, who used to be a sports blogger, and of course with sports dead, there's no gambling going on in there, so there's really nothing to do. So people like that have migrated into this space and are, bestowing their grace on this bankrupt company or this one, and just basically stimulating momentum trades. But the big problem with the resource juniors has been that their stories are complex. It's hard to visualize what is the size of the prize. If you're successful at what you're trying to do, what would the stock go to? And there's new platforms such as the Share Collective, of which I'm a founder, which makes it very easy for an individual to come up with numbers that, if they have a deposit this big with this grade, it would be this kind of mine, what would it cost and what would it be worth, and how should we price it right now that it's only still just a drill target. And the brokerage firms can't do that. The companies can't do that because that's forward-looking. They have to only report 43-101 stuff. But the influencers, the retail investors, they're about to get empowered to do this, and then they have their own little networks of followers, and then they overlap. And so the ability of not just a few powerhouse companies with big marketing budgets to attract the attention of large audiences and funnel all the capital into their particular stocks. Now we have a potential sideways explosion where an army of influencers discovering the resource junior sector, getting up to speed on how it works, doing their homework, and then using their social media platforms to send their perceptions, their understandings to broader audiences. This is why I think this bull cycle will be much more durable, much bigger than anything that we have ever seen in the history of the junior exploration sector. And you may sort of laugh at me because 4 months ago I was whining that the this ecosystem is on the extinction threshold, that it's dying, that there's not enough money coming in. It's amazing how circumstances can change on a dime, and I think that inflection is now underway, and the fact that the money is coming in, so much money is coming in, that's going to result in the flow of results that keeps this whole thing growing and growing.
We'll have more with John Kaiser when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser. John, is the growth of nationalism over globalism good for the junior miners?
One of the consequences of deglobalization is that you have to look for supply chains closer to home. And if countries end up squaring off against each other, such as, say, China and the United States, and it gets to the point of near military conflict, you might find that materials that are mined in China don't go to the United States, and vice versa. So this fragmentation of the global economy, carving itself up into smaller economic zones, alliances, they're going to be very different from the old Cold War alliances. That opens up interesting opportunities for the juniors. And right now, this activity that I'm seeing here in the juniors, most of it, in fact, is taking place in Canada, very close to home. I've been talking about back to America for a long time. Exploration should be happening in America. Unfortunately, they have really lousy claim staking systems. That their regulatory system still hasn't really listened to Trump's encouragement to, hey, relax, don't be so hard-nosed about everything. We are going to have a critical metals supply problem. So for the juniors, exploring closer to home, there's now this extra reason to go do that. Because before you would go into Africa, you would go into Siberia, these remote locations where there are world-class projects that have been unavailable because of civil unrest or the geopolitics and in a globalized economy. Why do you care about these smaller projects? It's all about go big or go home. But with this fragmentation that's happening, the supply may have to come from many more smaller to medium-sized resources. So this becomes the impetus for exploration. The really big producers, the majors, the Rio Tintos and the BHPs, they can really only focus their efforts on giant world-class targets. So they're on the sidelines watching this, and that will be a leg that kicks in later. And we've been talking mainly about gold so far. Nobody really needs gold for anything, but all these other metals are needed. And when the world finally gets beyond COVID-19 and starts to rebuild, I don't think it's going to sit there and say, okay, everybody go back to work in the bar or the meat packer or wherever it is that you had your job before. No, this is going to be coming out of a monster hole, and it will require something big to inspire the people. In the United States, infrastructure renewal, something that's been neglected because of this concern about creating a deficit, that's going to become the solution. Whether or not the Democrats get in power or the Republicans stay in, massive infrastructure spending is going to be the key. And that's really the third leg in this junior cycle. The first is this growing interest in discovery exploration. The second is gold repricing into a higher real range that increases the interest in the sort of gold sector. But the third will be when metal prices rebound. not just to their normal levels, but as a result of new demand. And it doesn't matter whether the world's fragmented or not, the collective demand will push up the real price of the base metals down the road.
And getting back to globalism, nationalism, could access to rare earths be a growing concern?
I covered the rare earth bubble from 2009 until it sort of fizzled in 2012. And that was a precursor of the kind of problem that the world will have, especially the United States, if China ends up withdrawing from the globalized stage. Right now, rare earth prices are still dirt cheap. They're even cheaper than they were in the wake of the 2008 crisis. So it's still very tough for deposits to be worth developing outside of China. But if we do have this growing problem, and China's showing no signs of backing down from its ambitions of becoming a head-to-head rival with the United States, we will see a crisis where suddenly there's no neodymium or dysprosium available to make your magnets outside of China. And if you're in a trade war with China, well, you're not buying anything from China, including the neomagnets needed to make your electric vehicles. So I think the rare earth space and many of the other critical metals, they are lurking in the background, waiting for liftoff. And they're not hot yet, but they're ready for that crisis where suddenly, when you see the rare earth prices lift off again, such as happened in 2010, then you definitely want to be jumping into those ones, or even already own them ahead of time while have some of it in your portfolio while you're playing all the gold juniors.
Mines are being shut down due to COVID-19. Is this causing shortages, and is this bullish for mining stocks?
People have been telling me, wow, isn't the copper great? It's down there at 220 or so, and now it's 275. Well, that isn't because demand is overwhelming supply. It is because supply has been decreased in the wake of COVID-19. In Latin America, which even though they've done a lot of lockdown, they have big problems with coronavirus infections. Mining in many countries was deemed non-essential, and we also have worker strikes emerging. So the supply of copper has been suppressed, and so the jump we've seen in copper is an artificial one. Other base metals such as zinc and lead, they're really low, like 95 cents for lead, for zinc, 80 cents for lead. These really, they have more diversified sources around the world where they don't have these lockdown disruptions of production. But these are temporary disruptions unless these countries go into free fall of civil unrest. And that's something we have to worry about, because this pandemic is hurting the emerging markets big time. The failure of the United States to get its act together and get this under control is extending the negative impact of this slowed global economy to the rest of the world. So if Congo ends up collapsing because of its own internal stresses, then you'll have a longer-term supply deficit for metals such as copper, and in particular cobalt, 65% of which comes from the Congo.
How do historical junior mining bull markets compare to today's market?
Jim, there's no comparison. When I started in 1983, we would have a 2-year cycle of juniors running because of discoveries, and then the discovery enthusiasm would wane. We'd have maybe a couple of years of bearishness, and then there'd be a new discovery. But what happened after 2011, that's unprecedented in the resource junior space. So any sort of patterns in the past, you can't really use them because we're in completely different, historical context right now. You have to go back to the, say, early 30s. And I'm not sure that the looking at the Canadian junior mining patterns of those days will tell you anything useful. So I think you have to just think it through in big picture terms and in terms of the narratives that are driving the market at the moment, and extrapolate the length of your cycle from that, basically from scratch, and don't look at the past as a guide.
How long does a typical junior gold cycle run?
Well, it's 2 to 3 years. The 2003 to 2011 cycle was actually a long one, but it had that interruption in 2008 when gold tanked along with the general market, but then rebounded afterwards. But again, gold wasn't released from its prison, $35 prison, until 1972, and it woke up in 1978-79. But after 1982, it was a dog for 20 years where, there wasn't really a gold cycle. There was like the usual crisis investing types talking about $2,000 gold and fiat currency debasement and evil socialism and hyperinflation and all that ideological crap, which didn't happen at all. And then gold got whacked when the United States managed to win the Cold War and was the sole superpower. Now we're in a situation where the United States it's still the sole superpower, but it's no longer showing that global leadership that everybody has come to rely on to keep the peace. So we're in a completely uncertain time frame. So that's I wouldn't say that the mining cycle for gold is anything to really worry about.
Are there seasonalities in your junior mining bull markets, and do they apply today?
Just in the 80s and 90s, early 90s, when Canadian juniors tended to stick to Canada, you would have the winter seasonality as a problem. In some places like Ontario and Quebec, it didn't matter because it's better to drill when the swamps are frozen, and you can move your equipment around more effectively. But in places like the Golden Triangle, unless you had an off-the-scale discovery on your hands like SK Creek was, you don't do anything in winter because the snow goes 10, 30 feet deep and the wind howls and visibility is terrible. So that seasonality is still there for those parts of Canada. After the mid-90s, when the explosion into the third world frontiers happened, you went into Latin America, you had the seasonality disappeared. And even now, I've encouraged some companies with projects in northern British Columbia. You probably won't get a drill program going this summer that has any meaningful results, but the market wants to own your stock. Go find something in Nevada, in the Walker Lane or somewhere like that, where you can work almost year-round so that you don't have these 6-7 months of nothing happen due to like winter arriving in October and not ending until late June. But in general, the seasonality is more based on where your projects are located, and they don't all have to be located in a place with seasonal constraints.
Is investing in mining juniors a high-risk speculation and not for the faint of heart?
Absolutely. It is gambling. You're gambling on uncertain outcomes. You're gambling on uncertain metal price trends. You're gambling on what's going to happen in November when the election has taken place. Do we actually have a new president? Has democracy been suspended to save democracy because the COVID-19 is raging and you can't guarantee that all voters exercise their voting rights? What's going to happen now? Everything's unpredictable. In fact, that's what's making this sector exciting, because the extreme uncertainty makes predicting where the general market's going almost impossible. The experts have thrown up their hands. Now, here, you can look at a project and say, okay, here's the chance that this thing turns into from a 100,000 ounce gold system into a 1,000,000 ounce system. You can quantify it. You can place bets. The risks are high, but the rewards are high. So, everybody wants to now gamble on stuff where they understand the nature of the bet, feel that they have some sort of edge in making that bet, that they have a better understanding of what is going on. They don't really want to be stuck just trading momentum, chasing fluctuations in foreign exchange, or even fluctuations in bankrupt companies like Hertz. That's why not being for the faint of heart makes this space so attractive right now.
John, where can people follow you and subscribe to your newsletter?
KaiserResearch.com. Just go to the front page. It'll be self-evident what you need to click on to register. And because I'm not working from the office, give me a day or two to get the registration and subscription processed, and we'll get you up as soon as possible.
John, thank you so much for being on This Week in Money.
Thank you, Jim, and you're welcome.
My guest has been Discovery Watch's John Kaiser. Coming up, John Rubino, next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim. Good to be back.
John, what could derail gold's bull market?
Well, the funny thing about bull markets is that they're never restful. When the bull market hasn't started yet, you're stressed because it's not happening. And then once it gets going, everybody starts talking about where to get out. When's it going to stop? When should you take money off the table? And gold is no exception to that right now. It's had a good run, but there are a lot of questions about whether it's sustainable from here. And, I think the usual suspects, if you look at them, the things that could normally derail gold are not a problem this time around, which is very interesting because, for instance, rising interest rates would normally be something that you would expect to negatively impact gold's price. But how can interest rates rise now? We've got such a huge global financial mess that for interest rates to start going back up, and certainly if they were to go back up to normal historical levels, that would bankrupt everybody. Every major government that has to roll over its debt would have to roll it over at higher and higher interest rates, which would raise their interest costs, which would make even bigger deficits, which would, just blow them financially out of the water. So nobody can allow interest rates to go up. So that's one thing that's not likely to happen. It's in fact highly likely that we'll have interest rates go down from here, which is good for gold because gold doesn't pay any interest, which means it competes with other safe haven assets in the financial sphere like treasury bonds in the U.S. And if treasury bonds are yielding, 6% like they have historically, then that's a really tough hurdle for gold to overcome because it costs about 1% to store gold per year. So if you've got a 7% negative difference in cash flow, it's hard to justify buying gold rather than treasury bonds. Well, now the difference is minuscule, so it's easy to justify gold, and it's likely to continue. One thing that could derail gold is a stock market crash, because if you look what happened in 2008 and in March of this year, when you had really dramatic declines in stock prices, they took everything down with them, including gold. So you saw gold and silver just tank. And, it felt like a bear market. It was a bear market. It was just a quick bear market before gold and silver recovered pretty quickly. This time around, I suspect it's the same thing, which means if we have a stock market crash, which we really ought to based on valuation, gold stocks are incredibly overvalued right now based on historical norms. So if we have another equities bear market, It could easily take gold down with it and the mining stocks along with gold. But it would be very temporary because governments would respond to an equities bear market like they have done for the past 20 or 30 years now, which is to say even lower interest rates, even bigger deficits, even more quantitative easing where they're just buying financial assets across the board. And that would be good for gold. So I think that a temporary bear market in precious metals, which would derail the bull market, would be followed by an even bigger bull market. So I don't think it's anything to worry about. Although it might be a reason to hedge yourself a little bit, just because that equities bear market out there is potentially pretty serious and potentially very possible. By the way, sorry about the dogs barking in the background. I hope to have that taken care of shortly. But in the meantime, we just have to live with it. But anyhow,
they're the dogs of summer.
Yeah, the dogs of summer. Yeah. But anyhow, yeah, not a big deal for gold. I think its bull market has legs. And even in bull markets there are corrections, those corrections should be short and sweet and easy to get beyond. As Rick Ruehl just said lately, there will be corrections in gold, but don't let it shake you out because this bull market has a long way to run.
Where does the current civil unrest in the U.S. go from here?
It's hard to see it getting better from here. We're a really divided country. And people on both sides are emboldened by the fact that they're kind of tribal now. They're living in echo chambers where they only hear people who agree with them. And within that echo chamber, because everybody agrees, they can say any crazy thing they want to and get away with it. So you've got people on the left just doing amazing things right now. And they're, for instance, if you're an African American in the U.S., you have good reason to be angry. But I think if you're just very, very liberal in the U.S., you have good reason to be angry. But the policy proposals that anger is leading to are incredibly dangerous. Like, defund the police and go to massive new increases in government spending financed with modern monetary theory, printing presses. Stuff like that is tremendously dangerous. And then on the right, you've got people who really don't want to listen to the legitimate complaints of the people on the left. And so, I think we could easily see civil unrest coming from either direction, which is very scary. Either the right or the left, continue in the years ahead. And you know what? The elites will just sit there laughing the whole time because this kind of distraction, in other words, where at street level, socialists and people from the right wing are battling, means they're not paying attention to the real enemy, which is a system which has been set up by the bankers and the political class and the corporate class to siphon money out of the 99% and into the accounts of the 1%. So as long as financial inequality is growing in the U.S., you're going to see civil unrest because the number of people who are angry about the way they've been treated by the system will grow. But as long as the people who are angry are focusing on the other group of working class people who are at the other ideological spectrum, or end of the spectrum for them, as long as they keep focusing on each other, they don't focus on the the aristocracy that has taken over the U.S. and continues to accumulate power. So, it's likely that we'll have civil unrest with one group of working class people against another work group of working class people until all the peasants figure out that it's the guys in the castle that they should really be mad at, and they all grab their pitchforks and torches and head for the castle. That's a second stage of civil unrest, which I think is coming. Something akin to the French Revolution, when in the 1700s the French peasants rose up and took all the aristocrats out of their castles and beheaded them. So hopefully it's only a financial beheading this time around, but I think something like that is coming in the not too distant future.
What's the latest on silver shortages?
Well, silver shortages are easing. There was a stretch there when you had to pay really immense premiums to buy physical silver, and you still had to wait a long time to get it. That is usually a prelude to rising gold and silver prices, and silver prices rising more quickly than gold, and that's what has happened lately. And right now, you can get silver more easily than you could have before, but the amount of silver that's being produced by mines right now has been cut dramatically by the pandemic, which means that the supply of physical silver coming into the market is not what it usually is, and investment demand is still rising. So the industrial demand for silver is down because the economy is very weak, but you've got people just buying silver coins like crazy and silver bars and things like that at a time when the mines aren't producing as much as usual. So I think that there's a decent chance that we see another explosion of premiums out there at some point. So it probably makes sense to grab what you can right now because, again, if the precious metals bull market continues, which it should, silver being relatively cheap to gold should do better than gold. So we could see the gold to silver ratio, which is around 100 right now, historically very high. In other words, it takes 100 ounces of silver to buy an ounce of gold. We could see that shrink to 50, 40, 30 or so in the later stages of this bull market, which would mean silver would outperform gold by, twice the rate of improvement from here. So it's great for silver, and the recent shortages set the stage for future shortages. So this might be a time when you have a chance to buy some relatively cheaply in terms of premium, and that might go away again. So now's a pretty good time to be grabbing a lot of silver.
When, if ever, will silver start to outperform gold?
Well, it's just starting to right now. Just lately, it started to go up a bit more than gold. Now you'll see gold go up by 0.5% in a day, and silver go up by 1.2% or something like that. That's becoming a more normal day. And once that kind of thing gets going, then silver really becomes a volatile to the upside segment because there just isn't that much silver out there. And when even a little bit of outside money starts coming in because they see it moving and, they may not understand, generalist investors may not understand precious metals, but they know when something is moving, and so they come in and start snapping up silver. That basically soaks it all up and means the price goes up even more. And that's happened twice. Once in the 1970s, when the Hunt brothers tried to corner the silver market. Gold was going up. Gold went from a few $100 an ounce to $800 an ounce. Silver went from a few bucks an ounce to 50 during that time. And then in the 2000s, kind of the same thing happened. Gold went up, silver went up much more to around 50 again. So silver is currently $18 or $19 in U.S. dollars. Which means that even if it just goes back to its previous highs, it has a really long way to run from here. And if it exceeds its previous highs, then more than likely it'll outperform gold dramatically along the way. So I think there's a decent chance that it's already started, with that caveat that there could be a big correction out there looming if stocks tank, which would take silver down more than gold. So you might have one more stretch of silver underperforming before it really takes off. But that's not the kind of thing you want to wait for with all your money. It makes more sense to kind of be moving into precious metals right now, and especially silver, with a longer term goal of $5,000 an ounce gold and $100 an ounce silver at some point. So I think that's out there this time around. And it may not be that long a time, just given how chaotic the world is right now. If we see another lockdown because of the pandemic, in the U.S. at least, I don't know how it is in Canada, but in the U.S., it looked like we had it under control. A lot of states started to open again, And now new cases are spiking, which means we may have to go back to some kind of a lockdown again, which would just be catastrophic for the economy, which could mean the second half of this year is extremely unstable, both up and down. So I think that the kind of instability that's definitely coming is good for gold and silver in the long run and very unpredictable in the short run.
What's happening with precious metal mining stocks?
Well, they're doing great. The miners have had a phenomenal run in the last 6 or so months. A lot of them are at, they're at like 365-day highs for sure, but multi-year highs also. And that's caused by two things. One is that precious metals themselves are going up, so these miners are seeing wider margins. If you're producing gold right now, you're getting $400 more an ounce for it than you got this time last year, which means your margins are just exploding, and you're going to report good earnings reports, which make you among the only companies in the world that are doing that. The stay-at-home stocks like Netflix and Amazon are doing well, but very few other companies are, except the miners. So they stand out in terms of earnings momentum. And there's also a growing amount of mergers and acquisitions in the industry because the big guys aren't replacing their reserves through current production. They're using more gold and silver than they're finding in their exploration programs. And to keep their reserves at current levels or grow them, they have to buy other companies that have reserves. So a lot of big guys are buying smaller miners, and a lot of the smaller miners are combining in order to get the critical mass to survive. So that kind of M&A tends to push up prices at the same time. So you're seeing these two really good factors right now at play. And again, there's no reason for that to stop because it's really just begun. They had a good quarter this last quarter in M&A, but the big guys are nowhere near satisfying themselves as far as their future reserves are concerned. So there are going to be a lot of big buyouts going forward. So I think the stars have really aligned for the miners. They're going to report excellent earnings with a growth bias. In other words, the good earnings they produce this quarter will be dwarfed by what they produce in future quarters based on the trends in precious metals. And that assumes that they make it that far without being bought out for a nice premium, So the miners are, they've been an excellent sector for the last year. They'll probably be a very good sector going forward. And if we have that stock market crash that takes everything else down, they are definitely worth snapping up at the lower prices that will just be temporary during that correction. Oh, and there's one other factor with the miners that's interesting, and that is the Robinhood effect. Robinhood is a stock trading app that's free, doesn't charge you any commissions or anything. And a lot of people who ended up having to stay home during the lockdown and millennials who used to play video games have discovered stock trading as basically a new game to play. So they're day trading now, which means they're trend following. That's usually how you day trade. You find a trend, you hop on it for a little while, then you hop back off for a small gain. But since your transactions were free, you get to keep that whole gain, and you do that over and over again, and you can grind out a nice profit in the course of a trading day. Well, lots of people are trading, and they're because they're beginners, they're doing some extreme stuff. Now, there's some speculation out there that with the miners having excellent earnings and price momentum, that they will be discovered by this new group of day traders, and that'll cause their prices to just soar. They'll be like .coms, where, if you got silver in your name, 1 million new people who have never heard of you before want to buy your stock, and that quadruples your stock, in the course of a couple of weeks. That kind of stuff might be happening for the miners too. You're seeing a lot of these guys have some monster days, 15, 20% gain in a day. And that could just be the new bull market getting going, or it could be some of that day trading money flowing in. But it's definitely not all in there yet. So we could see a lot of action based on that. And if you do see day trading action pushing up your stock, it may be time to sell a little bit to them, because you need to think of them as dumb money. And if they're doing something in a big way, then you want to be on the other side of that trade. So I don't, think we should be out of mining stocks at all, but I think some parabolic moves in some of these things would warrant a little bit of profit taking.
We'll have more with John Rubino when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with John Rubino. John, can China bail out the global economy again?
China is a very interesting story right now, because they're sort of in the United States boat, where one problem is manageable, but 5 problems may not be. We have all these different things going on right now here, and China's the same way. They've got, they're the source of the pandemic, and it still hasn't been concluded yet whether they actually created COVID-19 and released it on the world, which would be a whole big new thing if it comes out that way. But then they've got, they're saber rattling with Taiwan, and they've got civil unrest in Hong Kong, and until very recently they had that border dispute with India, and now they've got the Three Gorges Dam, which is this immense dam on the Yangtze River, maybe being in trouble. There's flooding, excessive rain upriver, and extreme flooding, and there are some people speculating that the dam can't handle the amount of water that's coming its way, and that it's liable to burst. If that dam bursts, that's a 1 million person catastrophe, where the deaths will just be off the scale for anything that's happened recently in the world. And it'll, dramatically affect China's economy, which by implication will affect the global economy. Now, as for whether they can bail us out, they basically bailed the world out of the Great Recession by quintupling their debts. They borrowed more than anybody else has ever borrowed in that stretch of time, a lot of it in U.S. dollars, and they did an epic infrastructure build-out. So they bought up a big chunk of the world's raw materials in order to do that, which basically funneled that money to the rest of the world and bailed the rest of us out. So we got a growing economy largely because China borrowed all that money. Well, they can't do that again. They're already having a lot of bad debts blow up on them, because when you borrow that kind of money in that short a time, a lot of what you do with that money is necessarily malinvestment, less necessarily a bad deal that doesn't generate enough cash flow. So they're already in trouble because of that past borrowing. So the idea that they can bail out the world is very far-fetched. And then the question becomes, who can if they can't? Because the U.S. is already at record levels of debt at pretty much every level of society here. So unless we want to borrow another $20 trillion and see what happens to the U.S. dollar when we do that, we aren't going to be the engine of growth going forward. Although, it's not clear whether we're going to try that or not. We may well try that. I think the result will be really bad, but we might try it. So we'll see. But it won't be China. Probably won't be Europe. Almost certainly can't be Japan, and shouldn't be the U.S. So it's not clear who it is that pulls us out of this current recession, and that's a very scary thought.
Will the pandemic ever end? And if it lasts for years, what does it mean for the global economy?
Well, we're at depression level growth and unemployment right now already. And if people don't get called back to work, for instance, half the restaurants in the U.S. that have closed so far are permanently closed, apparently. So it's not like we can just cut interest rates by a quarter point and start everything back up again. And if the pandemic lasts long enough that big sections of the economy just go away and will never come back, then you've got massive government spending going forward in order to cover all the lost jobs and all the other stuff that we need to spend money on, and with no real end in sight. So we are in a depression if that's what happens. If we went back to normal today, we would have had an epic recession, one for the record books, but not a depression because it would have been over fairly soon. But if it lasts a few more years, it'll get worse from here instead of better. And then we will be in something comparable to the 1930s, with the difference being that we're going to fight it with extremely easy money because we're not on a gold standard anymore. So, negative interest rates everywhere you look, and government deficits of 10 or 15% of GDP. I can't imagine today's fiat currencies surviving something like that. So where the Great Depression was a deflationary collapse, what we're talking about going forward, if the pandemic continues, might be an inflationary spiral, that is ended by a bunch of currency crises, after which we have to go back to the gold standard. So that was kind of always coming, but this really sped up the process. So now what would have played out over the next decade might play out over the next couple of years.
John, is there any way to somehow ensure that you financially survive this crisis?
Well, historically, gold and silver have done really well in crazy times like this, just because they're kinds of money that governments can't create more of on a printing press or in any other way. So they tend to maintain their supply, which means they maintain their value, and you can hide out there when everything else is spinning out of control. So that's one thing. And then real assets otherwise are good things like farmland, something that has utility tends to do well in crazy times like this because you can use it. You can create food with your farmland, or if it's a house, you can live in it, or if it's a rental house, you can generate cash flow by giving somebody else a place to live. Stuff like that does well and holds its value in crazy times, especially crazy times centering on the currency. So that's the kind of thing you need to do. You need to protect yourself by getting out of your government bonds and your dollar bank account, stuff like that depends on the value of the currency, and getting into things that have independent values, something that produces wealth regardless of what kind of crazy stuff is happening in the stock and bond markets. So that's the main thing that you need to do. And then pay off debt. There's a theory that, or in a kind of an obvious intuitive theory, that in a crazy time when the dollar's being less valuable, you want to borrow as much money as possible and then pay it back later in those cheaper dollars. But you only want to do that if you're guaranteed to be able to make your payments on your debts. Lose your job, have the assets that you thought you were going to use to pay off your debts go down in value or whatever, and then you lose everything. So don't try that at home. That's a very, very specialized strategy. It's much, much safer to pay off all your debt so that nobody has a claim on your resources that are left, and then put those resources into things that will hold their value. That's the way to safely navigate something like this. And if you want to speculate by borrowing money and buying gold with it, that might work out, but it's an extremely dangerous thing to do. So only do it if you are so sure you know what you're doing, and if you have any doubts at all, just don't do it because it's potentially catastrophic.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Kaiser, and John Rubino, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howestreet.com. Now stand by for our company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, the need to recycle batteries, you can see the future need for it with all of these semi-trailer truck electric vehicles now being developed, and they're going to have a huge battery capacity to look after.
Well, not just electric trucks, and I think Tesla has a pre-order on theirs for 650,000 or something. And so that's a big move forward. But also boats, airplanes. Just the list is continuous, and they're all lithium-ion batteries. So that makes a bright future for anybody in the recycling business, and certainly we feel that we're on the leading edge of that. And talking about recycling, we're still waiting for a piece of equipment to come in that had to be fabricated to get back on our optimizing the pilot plant. And, for some of the people that write in and want to know what the timeline is, it's hard to generate a timeline when you're totally going through a redesign that will take place after we've done this final testing. So, but we're getting there, and it's a work in progress that is very exciting. I can't wait for that plant to start up and see what our next capacity will be when we jump from 64 kilograms to 160. That was a big move, and that created some bottlenecks and some changes in design and changes in the fabrication of the metal types we used. And, maybe adding a couple of chillers in there because you've got more action going on a smaller space, which creates heat. But what can I say? It's moving ahead in a positive direction, and everybody should be happy about that. Now, we haven't had a press release for a bit, but it seems like every time we put a press release out, it's hit by a wave of selling. And for that matter, we've currently just I'm going to have an attachment on the site, and it's a movie on short selling, predator trading, which I think is everybody should read it, because it's an eye-opener, and it talks about companies that have been slaughtered totally on the U.S. exchange and the NASDAQ, and gone down to nothing from a great start in a company to absolutely nothing. So that's a YouTube video that everybody should watch. They talk about the predator trading and how that worked in the 2008 crash. And the only thing that they don't mention in there, which tells me that even though they put this eye-opener out, it was censored somehow because didn't talk about the fact that the SEC removed the uptick rule in 2007. And in order to get the American markets, especially the Dow, back on track, they reintroduced a uptick rule, which is a partial rule where you can only short the stock down 10%. I know there's my detractors on the board that go poo-poo and all that stuff, and but it just happens to be a solid fact. The article I'm putting out is from Save Canadian Mining, which Eric Sprott is a part of. And I think it was a great like I say, an eye-opener for anybody that wants to follow the shorting that's going on. Give you an example, a gold company had a spectacular intercept of gold, announced it yesterday and went down 10%. And, those are the types of things that, because the volume increases and predators like to sell into volume, they need somebody to buy it and hopefully take it down. And although that stock, has turned around and it's back up to where it almost started right now. But that was yesterday. And what I started to say was that, why didn't they mention the fact that they got rid of the uptick rule? Certainly in Canada, we got rid of that it was finally agreed and approved in 2011. You saw what happened to the venture exchange immediately. It just waterfalled over the cliff and went down, and now it's struggling back. And I'm happy to say that gold has certainly helped that market. Everything's moving up. We've got a good cobalt project in BC, and we're looking to optimize that. And so there will be news coming on that in the next few weeks. And the idea is to basically take that as a standalone project and move it through the chute. And if that means creating a new company out of the old one in which the shareholders would all benefit, then that's exactly what we'll do. And so it's exciting. It's the coronavirus has certainly set everything back. Everything circles around that plate. When you read an article in there that I get something like 300 to 400 emails a day that I have to go through in the evenings and the daytime, and because you're always looking for what's the next innovation, who's your competition, where's the market standing on recycling, all those different things. So you have to go through it, and a lot of it is just deleted immediately. And but then some of it you have to go through. You're looking for nuggets in those, so we're doing that. And I'm happy to report that we're at about 82,000 reviews in our OPED as of this last Monday. So that's about equal with what our first OPED results on the reviews that we had. So we're probably at 225,000 views on the 4 op-eds that we did, and certainly that's getting into the right hands. And we're happy with those results. That we've actually never seen that type of result before, and that goes into a whole brand new genre of investors and technicians and people that are following the markets through the economic standard. So that's fantastic. And we're going to also attach a article that was done on Jeff Don, who's one of our pioneer battery guys. He's well known. He's tied in with Tesla. And so we'll be attaching that. You will see some of our ads on there for Recyclical. And so those are all positive things. That's puts us out in front of new eyes, and it can't hurt the ongoing program with the company. So I wished I could say exactly when the plant's starting up. I get I get queries about that. But, that's out of our control, things that are always out of your control, especially with RD, research and development. So, you got to fabricate, you got to go to specialty areas to get those fabrications done. You've got timelines, you've got extra cost. But, we're getting through all that. So, I'm just waiting for the phone to ring and the Chemetco to tell me that the final parts are in, and that they will be starting the plant up in a few days. So that's super. Now, I really have to say that I just love this gold market. It's going crazy. It's not just the gold market. You look at the price of copper, Dr. Copper, which is the big indicator when it comes to the mining projects. It's up at $2.80 now, which is 70 cents higher than it was here, several weeks ago, and when it went down to $2.10. And 280 is a great place to make an entry on that sort of thing. And speaking of that, our copper gold property has had a past mine on it, and the average grade of copper that was on that mine was 6%. So something's up there that is creating all this, and now we want to focus on that in a new genre and try to capitalize on what we have. We think there's a decent ore body up there somewhere, and it's just a matter of finding it. So we've spent a few $1 million on it, but not nearly enough to identify anything. But it's an exciting time for the company, and I just want to wish everybody a great weekend. I plan on basically resting up, and no place to go, so and I don't want to drive out in the country and park in a tent somewhere. So that doesn't fit my bill, and but I guess I'll sit home and catch up on some of the movies I've missed.
Larry, where are you traded, and how can people get more information about American Manganese?
You can go to our website at AmericanManganeseInc.com. We're traded on the TSX Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can always contact the company and myself at LREAUGH@AMYMN.com, or phone us at 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 10th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.